This is Phantom 6, and this is a video on how to sell a put on the Etrade platform. So we've got ticker here AAL for American Airlines, and we can see that the underlying price is $11.94, and the extended hours price for pre-market this morning, Monday, July 13th, is a little bit higher, up 1.68%. So what we've experienced here in the last few days has been the decline of the stock price of American Airlines. You can see over the past month we reached a high around probably $17, give or take a few cents, and now we're back down to $12. So we've had quite a decline here, 16th to the 9th. So that's a pretty decent drop here fairly quickly. And of course we're in a really volatile market right now anyway. So let's look at one more thing here on the chart. We're going to see, just for reference, and take a look, and you can see before the crash, the Corona crash 2020, we were trading above $25, bouncing between 25, 30 bucks, and it looks like we were a little bit higher than 30 further back, but I'm not too concerned with that because we still have a lot of fundamental questions about what might happen short-term, medium-term here for this stock and the overall economy. So you can see here, looks like in the crash lows we were chilling around 8, 9, 10 bucks. Found pretty good support and demand down in that range, and so we're starting to get back to that range. So historically, even after the precipitous drop following the crash, we've got somewhat of a basis here to say, I'm pretty confident that that's going to be a level where the stock isn't going to continue to drop. So if we look at being close to that level again, we're looking at, probably ranging somewhere from this, $11, $12 range up to at least $15, if not, up to $20. So we've got probably 30%, 25 to 30% of an upside move that we're looking at here somewhere soon. So we want to take advantage of that. Buying options means that we have to pay a premium when we buy an option, and so we want to sell an option so that we can get paid on the premium and have theta or time decay work in our favor. So we're going to look to sell a put. Puts are a bearish trade because when you buy a put, you're buying the right to sell short a share of a stock at a future date. But we're going to take the opposite side, so we're going to sell the put, which is a bullish side of a bear trade. Just stick with me here. So we're going to go out, just for this example, to January 2021, just because. Nothing really important about that date, just completely arbitrary. So the stock currently is at $11.94. And remember, when we looked at our chart, I'll pull it back up here, just a few months ago, we were trading, not even a few months ago, we were trading up here around 14, 16, $20 range. And if we go back to the 1 year, 25, 30 bucks before the crash. So what I want to look for is I want to look for something that is going to give me upside potential without risking too much on the downside. So I think that where we're at now, historically, we've got a lot of room to run. But again, I want to get paid. I don't want to have to pay. So right now, because I'm filming this pre-market, the bids and the asks are not populated. So we're just going to go off of what the last price was, and we're going to use that one arbitrary number. In a future video, we'll talk about spreads on options, how to potentially take advantage of playing those spreads and profit off of that by slicing off some pennies or even dollars, depending on the volatility of the stock and how that correlates out to the options. So if we take a look here, I think $10 is a pretty safe price bet. If we wanted to be super safe, we could look at, say, maybe $8. And we're going to say $1.94 there. So the way that this is going to work is I've got an $8 stock. Strike price is $8. So that means that if this option were to be assigned, it would take place at an $8 per share strike price. So what I'm going to look at here is, okay, so if the stock goes from $11 down to $8 and I get struck into my option, I will get paid $1.94 per share to buy that option at $8. which means that my value, my cost of ownership, is the $8 strike price minus the $1.94. So my true cost of ownership, if the shares are purchased in my name at $8, my true cost of ownership is $6.06. So I already have $1.94 of built-in cushion in my position that I got paid for to be in this position at $8. Stick with me here. So what I'm looking at doing here is I'm going to look at the $8 strike price, and I want to sell American Airlines put. So if I'm going to the bid, I'm selling. It's going to load a new screen for me here, and it's going to look like American Airlines put. It should autofill. If it doesn't, just follow me here. So American Airlines, I'm doing a put option. I'm ignoring this. I'm selling to open. So you can buy to open, you can sell to open. There's two different things. Just like if you buy a stock and go long, or if you sell short a stock and you're bearish. Same exact principle. So I'm going to sell to open because I'm selling a put. I'm not buying the put, I'm selling the put. And every one contract represents 100 shares. So if my limit price is $1.94, you can see that my proceeds, which will flow into my account if and when the option is either struck out or expires, is $193.58. Why the difference is because the $1.94 minus the estimated commission of 50 cents, you're looking at $1.9348. So say that I wanted to just do this one option. Well, this is exactly how I'm going to be. Again, I'm not playing the spreads here. So limit price $1.94, duration good for day, good for 60 days, good until a specified date, immediate or cancel, which you don't want to do on this, fill or kill, which you don't want to do on this. So you probably just want to do good for day, because the stock price is going to fluctuate a fair amount intraday. You don't necessarily want to leave that same order on for 60 days, because it'll either have you catch a falling knife potentially, or it will have you basically miss an entire move by not tracking and updating and following your position. So this is it. This is all I want to do. American Airlines, I'm got a put. So there's all these different ones that you can choose from. There's call, put, spreads, different types of straddles, all kinds of stuff. Animals, you know, zebra, mermaid people that are in here you can choose from. But we're doing a put, sell to open, one quantity. If you want to scale this out, you can do 10 quantities. And here's the cool thing about this, is so now when I start scaling out my options, I'm looking at getting paid $1,934 by or before January 15th of 2021 for selling this option. If this option goes, say the underlying stock price goes from $12.18 up to say $17, you would expect that the premium for someone to buy the option to sell the stock short at $8 would go down, because at $17 you've got way less percentage chance of hitting an $8 per share option versus at $12. You're much closer. So if you move up, say 30% appreciation and upside value of the underlying stock price to $17 area, then no one's going to want to pay $1.94 for that. They might pay 5 cents, 10 cents. At that time, we can buy to close the option back, and say we put in 15 cents. It's $155.16. So what was our initial value here? $1,934 is what we were going to get credited to our account initially, minus 155.16. So when we buy back, the difference is going to be $1,778.84. And so that would be our profit on basically flipping premiums, if you know, we don't wind up holding this till expiration. So then we're going to, let me go back here to sell open, my $1.94, and I'm going to double check American Airlines, put, sell open, 10 contracts. For this example, I'm just going to use the one. I'm good on everything. Preview. Okay, so that's because I've got this account here. Let me switch it to the right one. Okay. You can see it's just asking me to double, triple check. If you want to, you can drop down this purchasing power impact screen, or not, because you should already have done your calculations before you get here. Place order, and obviously because it's pre-market, it's not going to hit right away, but that's basically all that you do. So I'm going to go ahead and cancel out of here, because that was just an example. And again, this is Phantom 6. Thank you for watching my video. If you have any questions, feel free to reach out to me.